So, warm welcome everyone to this session on Film Wolves Ask Me Anything, where we asked our interested investors and wealth managers to send in your queries on investing in startups, and we will be answering them with the help of Mr. Apoorva Vora today. Now, firstly, before I get into Apoorva sir's introduction, I'd like to thank everyone for sending in their queries. We had an overwhelming set of responses, and we'll try to cover almost all of these aspects in this session today. Now, Mr. Vora comes with over 4 decades of experience, 30 of them being from the financial services space, and having led verticals across his career. He has also been mentoring startups for a long time and is well known in the alternate investment space, both domestically and globally. Being regarded as one of the architects of this new asset class, he will be answering the queries that we've received today.
Why startup investments make sense in the current market scenario?
Startup has become an acceptable variant to the investment asset class for an investor these days. And there are multiple reasons why startups are gaining popularity as an investment asset class now. First and foremost, there is much better awareness around startups than what we have seen few years back. It is not only about how many startups were registered 10 years back versus today or anything, but the fact is that more and more startups getting registered, more and more use cases that people are seeing how startups are adding value to life. A lot of individuals have become consumers of some of these startup companies. It has all helped in terms of integration of startup with the routine life for people. Now, when you see that a startup is an integral part of the ecosystem, and when there is an opportunity for someone to invest into that startup, investors are far less reserved in that sense for them to look at startup as an asset class now. So that's point number one. The other important thing is there was general lack of awareness amongst people around startups. But with more and more learning, more and more knowledge which is spreading around the startup ecosystem, it's easy for people to relate and start thinking of this as a new asset class. Even the wealth managers, who are integral part in terms of advising investors around investments in general, have become a lot more warm to the idea of startups now than ever before. There is a need for investor to look at something beyond the traditional. There are a lot of people who in their routine life deal with startups as CXOs, would have seen startups getting groomed. All these points together are creating a popular or a positive environment for startup to be part of the portfolio. There were very few angel funds which were available in the past compared to what we see today. So investing has become much more easy. There was a belief that for someone to invest in startups would require huge sums of money. That myth is broken now. It's not too difficult from an allocation perspective to try this kind of an asset class now. So when the investors have invested in traditional asset classes, have made money, there is a tendency for someone to go into something which is a bit more newer from an asset class perspective. With a little bit of better understanding, people can try out, and trying out is not too difficult given the fact that the ticket sizes are not too difficult. Last but not the least, there have been performance of some of the startups which have actually made a big difference. More and more startups have got listed now than what we have seen just about 2 years back. With startup listings happening, the internet economy being now even a formal index on the Bombay Stock Exchange, this is becoming more and more integral part. And then investors have now started having this feel that much before the company turns out to be an IPO bound, if there is an option for them to invest in early stage, they may not want to miss out the early stages also. We believe that startups now are here to stay as an integral part of the asset allocation of an investor.
What should I do or follow to learn more about startups?
So startups have become popular much more than ever before is something which we've been saying for some time now. A lot of factors have contributed to this particular scenario. Even a simple thing, a reality show like Shark Tank, has become very popular amongst people. It may have started as a fancy for people to know what startups are. To now, people have started making guesswork around which is a good startup and which is not a good startup. I think that's a very healthy scenario for startups to be in. More people understanding about startups, the kind of use cases, differences that they can bring on to the consumer. All this is leading to better and better awareness for startups. For someone who wants to follow this, I think some of these kind of things are very easy first steps. Is first. Second, equally important is there are lot of articles, lot of news items which the media would carry out about some of the success stories or learnings from the failures, all put together. And all this is leading to a better and better, more refined startup structure in the country. Government publishes data around the registered number of startups on a very regular basis. These are also getting highlighted and people are taking note of all this. There are government bodies, there are private sector bodies which are creating awareness programs on startups now at various places, pan-India. And all this is leading to greater degree of awareness amongst people. As a potential investor or even as a participant in startup ecosystem, if you get a chance to be part of any of such exercise, we believe that you should always take that opportunity, learn more and be more equipped. The good part is there is no longer a scenario where there is an aversion for startups. They have become integral part any which case. So it is easy for people to relate. And scenarios are very much visible to us, where you have programs like Shark Tank being even presented in school annual functions. So the awareness is building right from school days, to college days, to reality shows, and even the senior citizens of the family have started talking about what is a good startup, how somebody was promoting to the jury members or sharks as they call it. All this has become integral and very interesting part. I think anyone who want to follow startups should follow these kind of basic practices. Go to print media, the visual media and every other thing. And don't miss out on a chance to listen to startup founders if at all you get a chance to do that. I think that's a good way to be oriented towards startups and startup investments.
What are the broad evaluation criteria you follow at FinVolve for startups?
So startup evaluation is a fairly lengthy exercise and it is much more complex than what one can actually think about. So it's a very difficult point for me to explain in brief, but let me attempt to do that in simple terms. In most often cases, the founder of the startup is a very important element for anyone to look at. So when we evaluate startup, we need to have the confidence in the founder to be able to deliver something which is expected of a founder. It should actually be generating enough interest to people like us by a statement that it is supposed to solve a live problem of the society. A startup which is of no use to the society is of no use for any business investment as well. So it should have a market. It should have a total addressable market which is large enough. It should be solving specific problems and it should be in a position to service that particular segment of the market which it is targeting. We also have to look at whether the founding team has the ability to exploit the situation and be able to do something wonderfully well to run the business. Why it is important? There are multiple factors which we could go in. But for example, just to cite an example again, if there is a startup which is tech-enabled business, and if one of the co-founder is coming from a strong technology background, that becomes an advantage to people like us versus a founder who doesn't come from a tech background, especially when it's a tech-enabled business. There are many things like this which are to be seen. What is the kind of orientation for the founder to make business calls, revenues, and profitability are another important set of things which we need to evaluate when we talk to a founder. The projection should be realistic. The company's business plan should be realistic. And then there are a lot of these kind of things that we have to look at. Independently, there has to be, through agencies, external agencies, our own internal strength, our own internal due diligence, all put together and all machinery to be used together. We have to come to a judgment that whatever the startup founder is promising, is he or she in a position to deliver that kind of promise or not? That is very important. We also look at the peer group, whether there is something which is really very unique which this startup will be able to do, or it's a replica of an existing business model which is thriving, in which case very well. So there are too many such parameters that we have to look at. There are financial due diligences to be done, there are legal due diligences to be done. We should even check whether there have been any defaults in terms of statutory payments and likewise. So it runs into a massive exercise. It's not an easy thing for anyone to do. There are a lot of practical problems that we face. There are multiple pitch decks that we encounter on a regular basis. We have to filter out of that, looking at the merits and demerits of individual startups. We end up spending time with the founders on Zoom call, on face-to-face meetings. There is a specific exercise of mentors and the advisory board members who again validate a particular idea, check on the success or the potential success that a startup can have in the market. So this is a very, very long exercise that happens. One more factor that we need to look at is, as an investor, when we invest in a startup, it should also give me a comfort or give us a comfort of a potential exit over a period of time. Because when we are investing as funds, exitability of an idea is also very important. There are certain businesses which may do very well over a 10 or a 12-year period. Will we have the patience to wait for that company for 10 to 12 years? And even if the business is compelling enough, we need to see whether in interim, is there an interim exit available to a little larger player where we can exit out in between? There are these many things that we need to look at continuously before we come to a judgment whether the startup is invest worthy or not for us. But I have to add one thing here. The exercise is much longer, too difficult for me to summarize in few minutes and tell you. But it requires a very large number of people to be involved in this exercise. This cannot be a one-man show. It's not a judgment looking at the balance sheet and saying that here is a check and run the business. It doesn't happen that way.
What due diligence do you conduct before investing in a startup?
Whenever the investment is made in any startup, there is an agreement in place for us to get regular updates from the startup, even though we could be a minority investor in that company. So even though it could be a minority investment, we have access to the company's performance on a regular basis. Now, when that access is available to us, the investor in the fund by default also gets the same update consolidated by us, because when the portfolio comprises of quite a few number of startups, there is no point reaching out to investor with every update every other day. But there is a consolidation that happens at the fund level, and then this update is then transformed back to the investor on how the company has been performing from the date of investment. Now this is quite transparent because on a regular basis, this is updated. There are audited reports that you have access to, month on month, quarter on quarter, how the sales is moving, how the path to profitability is moving up to, what are the margins at which the company is operating, which are the newer geographies the company is expanding into, if there is a dealer network, how the dealer network is improving, if the consumer count or if there is internet economy kind of businesses, how many users are actually using the mobile app. All these data is something which is accessible to us, which is compiled in a format. There is also a peer group comparison that happens. And then these kind of updates are given to investors on a quarterly basis. There are generic monthly updates which are given to investors as a separate monthly note also. And at the end of the year, there is an audited report which goes to the investor from a third-party auditor as to how the investments are behaving. So the reporting structure in that sense is fairly transparent and it's a very well laid out process. From a regulation point of view also, this is mandatory for a fund to provide to the investor.
If one of our portfolio companies does well and we exit, and later that company grows even larger, how do we handle missing out on this larger return?
So there is this hypothetical scenario which can happen in startup investments. If we have invested in early stage in a particular startup, we have to start thinking of exit within reasonable time. The reasonable time usually is not too short, because every startup, for it to start delivering real good quantity in terms of deliverables or the promises that they would have given early, we need to give time for a startup to really grow to a level. Many times, the promises given could be achieved very easily in short period of time, whereas in some case, startups could face considerable headwinds also, and they may take time to deliver. Therefore, there is no easy formula that if we have invested in a startup, third year or the fourth year or the fifth year is when the exit will happen. We have to take an individual call. What would be an appropriate time for us to exit? Now that is a time where anybody as humans can go wrong. We might take a call that the startup has done very well for the first 3 years or 4 years, and going forward the exitability might be a challenge because the startup has grown to be very big enough. We might not get very easy exit, and possibly or hypothetically IPO is still some time away. In such scenarios, we may have to take a call and exit midway through. It may so happen that we exit and the company continues its own great journey very well. It does much better, performs exceedingly well. Now, after having done the exit, if the company does very well, we have missed the bus subsequently. We have no choice but to look at the journey that we played with the startup founder. The startup doing well. At our exit, what is the kind of money we made? And if that money made is reasonably decent enough, we have to ignore the journey thereafter and leave it for someone else's wealth. We have missed the bus, we admit it, and we close it there only. It is a double-edged sword. If we don't have the right exit at the right time, and if the startup doesn't do well subsequently, we will crib much more. Therefore, it is a call that we have to take for an appropriate time for us to figure out an exit. This is a very typical phenomena where anyone can go wrong. What we are very clear about is that if the startup idea is good enough, we may not want to miss out on participating in that startup. After participation, the multiplier is not necessarily in our hand. As long as it is giving our targeted returns out of the company, we may take a call to exit midway through. So our message to the investor would be, there is nothing called optimal scenario for an exit. Whatever we feel to be an optimal time, we would want to take an exit. But there is a risk that we may exit out early and the company may do well. And there is a risk that we may exit out early and the company may not do well thereafter. Mostly we believe it will be even Steven thereafter. But a call like this is mandatory for us to take.
How do you ensure liquidity for investors if an exit takes longer than expected?
So there could be a time where the exit may not necessarily happen as per our plans, because the startup may face headwinds. Even startup may not be able to grow at the same speed. It could be competition, could be any other factors. Anything can happen in early stage businesses. But as early stage investors, we knew few things very well. Because you come in early, you have more rounds for you to participate and look at exits compared to if you would have entered at a very late stage for a company. A late stage company has no other choice but to wait for an IPO, for an exit in most often cases, or a large merger and acquisition. As an early stage investor, we have more chances of our exits midway through. It may so happen that some of the company may find challenge in timely exits. Where we foresee that exit may take little longer, in such scenarios we try to find out exits early whenever there are exits of future rounds which are happening, including potentially a secondary sale if we can do, to manage that exit better and not wait for too long. In an unforeseen scenario, where it takes a bit more longer. We have no other choice but to hold on to the investment till the next trigger for an exit. Luckily enough, we need to understand one thing. The SME IPO exchange and that entire way in which the SME IPOs are now getting popular, even if the startup doesn't grow to be a main board IPO candidate, there are chances that if the startup is doing well, and just because of prolonged exit opportunities, an SME IPO is also an interim exit opportunity for a lot of these kind of companies. We, being early stage investors, generally get more chances, including some of these kind of opportunities, to create liquidity for an investor. That is how the endeavor is, and this is what we work towards.
What is the general holding period and potential exit routes for these investments?
Typical holding period for a startup would vary from startup to startup and more so for industry to industry. There are certain startups which we have seen who can get acquired, who can get merged into other entities in a relatively shorter time. There are more number of aggregation of businesses that happens in certain industries. Certain industries take time for them to grow. So the answer of what is the usual holding period for a startup, the short answer to that is it varies from industry to industry. But if I were to aggregate all this and start looking at that what could typically be the holding period for some of the startups, the answer would vary anywhere between 4 to 6 years, depending upon the company, the founder's ability to find partners, and exitability overall. There are very few cases where it could happen even before that, or in some cases, it could happen even much later than 6 years. The exits happen in multiple folds. One easy exit which we have seen happening in many cases is a startup founder has created a business. It reaches a certain stage and a larger player finds a great strategic fit for them to acquire a particular business. In India, we see this to be a relatively lesser phenomena, but in global markets, if you look at bulk of the real large organizations have become large by acquiring small businesses en route for them to become very large. Right? In India, the corporate venture capital or the CVC as we see is not as active as we are seeing globally. But these kind of acquisitions have started happening in India as well. And therefore, that is the first level of exit that happens in a very natural fashion. There have also been times where even a failure in startup or a relating failure in startup could have resulted in exit. There have been times where those kind of startups are acquired by a larger player in form of acqui-hire. In some of these failures, investors may not get the full money back, but there is still a partial exit possible. That is another option. You have also witnessed scenarios where a company which is doing well, likely to become IPO bound, before IPOs, they will pick up a couple of few other ideas which are strategic fit post IPO for them to really run very well. Just to namesake, if we talk about some of the companies which have done extraordinary number of acquisitions, is a company like Nazara Technologies, which is already listed in the market now. Right? So those kind of acquisitions are one more way for us to find exit for our portfolio companies also, if there is a strategic fit. Typically, when you come in early, an early stage venture capital fund would look at companies which have done in the initial period, which have done well in the initial period. Now, those kind of companies which have done in the initial period are fit companies for a VC fund to acquire and take them to the next level of growth. If suppose we don't participate and we are not able to get an exit in that period and the company continues its northwards journey, we could have a scenario where a slightly early stage PE fund would come in and then look at this company to acquire, or participate in and we get the secondary exit available. Secondary market for startup deals are now becoming a reality. There are funds which are getting created around secondaries now, and therefore exit opportunities are no longer as big a challenge as what it looked about few years back. And the SME IPO and the main board IPO options are always options available for someone to grow and exit out at that level. In short, there are multiple avenues available for exits. And only in case of a very unlucky scenario, there could be an extended prolonged period for an exit. SEBI has come out with a clarification, or rather it is a rule, that only accredited investors can invest in angel fund. Let's understand what do we mean by accredited investment. An accredited investor is one whose financial net worth is rupees 2 crores or higher, excluding the primary residence in which he or she is living in. So first and foremost is that SEBI believes that angel investing or early stage investing is not meant for all investors. This guideline becomes the first filter to ensure that only people who have a certain degree of wealth can come in and invest in angel investments. That's the first criteria overall for an investor to keep in mind. If the net worth is less than 2 crores, then he or she is not qualified to be an investor in startups. The second thing is, as far as fund is concerned, a startup fund or an angel fund has a minimum investment size of 25 lakhs which the investor has to commit. In most often cases, the 25 lakhs is not to be paid upfront. Again, in most often cases, this is to be paid in installments over a 2 to 3 year period, depending upon the character of the fund. So, the minimum criteria for investment, the eligibility criteria speaks about 2 crores of financial net worth. For an individual, the criteria for a LLP or a private limited company is different, but for an individual, it remains 2 crores. The minimum commitment to a fund will have to be 25 lakhs. Now, as a subset of this, somebody may ask, what allocation of the total portfolio should be given to startup investments? SEBI's guidelines, as we just spoke about, says 2 crores should be the minimum for you to qualify to be a 25 lakh rupee investor. But ideally speaking, this depends upon, or what percentage of your money should come to startup should depend upon your own risk profile and your overall allocation of the portfolio. As long as the entire portfolio is not known, nobody can give you a comment of what percentage should be invested in startups. Ideally speaking, your wealth manager or your advisor, your financial advisor, is the best person to be able to tell you what percentage of your money should go in the name of startup investments. We believe that this is something which you should always check with a qualified advisor before taking any judgment.
How do I start investing?
So how should one start investing in startups is quite simple. Our understanding is that the best thing would be for an investor is to go in and look into a diversified portfolio or creating a diversified portfolio of startups. It would be extremely risky to pick one idea or two ideas and say, I will wait how these startups actually perform over a long period of time, and then take a judgment whether I want to remain a big time startup investor or not. That would not be a good idea, because we believe that it is better to remain diversified. Do not put all your money into one or two startups. That could be very, very risky, because invariably startups do carry higher degree of risk compared to other asset classes. But a diversified portfolio across various startups, across various themes, is always very important. Do not make the mistake of investing only in one theme and build a portfolio around one single theme. So as an investor, it is prudent for one to take a decision to be well diversified in form of sectors and themes, also to a certain extent in terms of the stages at which you are investing in a startup. While it is all early stage, you should still look at, some companies might not be making revenues, but you have an idea which is strong enough. Some companies you should pick up which are revenue making and should have customers and growing at a certain traction. So all this one needs to look at and decide. Luckily enough, all this is available at a fund level if someone takes a decision to give the money to a fund, which makes a good diversified 20, 25, 30 startup portfolio for an investor with the amount which is getting invested. But that is something which is very important. We also believe that if you individually cannot monitor the startup and the activities of the startup, it is better to look at the fund route and come via a fund in general. But as an investor, a couple of most important things to keep in mind is do not try to invest in one or two startups alone. Create a diversified basket. Diversification should be across sectors also, across geography also. It doesn't make sense for anyone to invest in startups from one single location. So as more diverse you are in terms of your portfolio, you are reducing the risk at the portfolio level. And that's the best way to become a startup investor.
Hope you found this session insightful. If you have any additional queries, please feel free to reach out. Please feel free to write to us. We'll be sure to get back. Should you want to read more about Finvolve Ventures and the work we do, you can check out our website and our social media handles. The links or the details of which should be on your screen right now. And we hope you stay tuned because we'll be doing more such informative sessions in the future.